Hey everyone, in this video today, we're going to be discussing and debating CDs versus annuities. Which is best and which situationally should you be considering for your financial planning? So first, let's get into CDs, or otherwise known as a certificate of deposit. So what is this? This is typically an arrangement where you're walking into a bank or a financial institution and you're putting your money into this certificate of deposit where they're going to certify or give you a certain interest rate on your money for a certain period of time. Now, because it's with a bank or a financial institution, typically it's insured, it's protected. So if anything happens, your money's extremely safe. There's no risk associated with this money. It's similar to a savings account or a money market, but the difference is you're putting it in and you're committing it for a certain amount of time. Now, how does that work? Typically, short-term CDs are anywhere from 3 months to a year, most commonly 3 months to 6 months. You've got midterm CDs, which are 3 to 5 years, and you've got longer-term CDs, which can get up to 10 years. So it just depends on the duration, and the shorter they are, typically the lower the interest rate, because the bank is holding your money for a shorter amount of time. Longer periods may or may not, it's not always the case that they're a higher interest rate, but you're guaranteed that for a longer period of time. Now, here's the thing to look out for. So you're going to go and put your money with the bank or whoever, and they're going to give you a certain interest rate during that period. So let's say you're doing a 3-month CD and you put, $10,000 in there. Well, here's the mistake people make is they go to the bank and they say 3% APY, or the banker says, hey, it's 3% for a year. Well, a lot of people, they blindly, when they walk in there, they associate 3 months, 3%. I can't tell you how many little old ladies I work with that they're so excited about their CD because it's a 3% rate. And then I ask them how many months it is. And they're like, well, it's just 3 months. I keep re-upping it, or it's 12 months. And it's 12 months, and it's not even a full 1% or something. Well, the mistake people make is that they don't consider that APY is the annual rate. Well, if it's only 3 months, you have to take that 3% and divide it by the amount of months in a year, which is 12. So 3% divided by 12 times 3. So you're not actually getting 3% on your money. And a lot of people just blindly don't even think about that. They don't consider it. And so what they keep doing is they keep locking their money up. They keep rolling it into the bank. Meanwhile, how does this benefit the bank? Well, the bank is willing to give you that interest rate because they're able to go lend that money, go buy real estate, whatever the business priorities of the bank that you're working with is. And obviously banks have to be very strict. The money's guaranteed. So they're not taking tons of risk, but they know if they go take your dollar, they can go make a few more dollars with it than just one over that period of time. And that's why they're willing to give you that interest rate back. And so the bank is putting the money to work over that period of time. But CDs are an amazing place for you to have money if you're thinking short term. So what I mean by short term is for sure less than 1 year. Now, situationally, what am I talking about? I'm talking about the person watching this right now that you've just sold a business, you've just sold some real estate, you just got an inheritance, but you're in a holding pattern. For the next 3 to 6 months or even 1 year, you know what the next thing is, or something's coming, but it's just not there yet. It's a good way to, especially before rates get cut, as the time of this recording, they're discussing cutting rates. Well, it's a great way for you to lock in a rate for a period of time before they go up, before they get cut, because a money market account or a savings account, it could ride the interest rate. It could just continue to go down. So it's a great way to lock that in until you're ready to use the money. So yes, it's held up for a period of time, but you don't need it anyways. Now, it's not a great place for emergency fund dollars. I've seen a lot of people get in sticky situations where they put it in the CD, and then they have an emergency, and it's a couple $100 fee to there is a fee to break it. So they break that certificate of deposit and they pay a fee to get it out. And so it's not a great place for emergencies, but if you need a place to park money for just a few months or a year, it could be a good place to have your money. Here's a con to a CD that a lot of people don't think about. It's very tax inefficient. And so how it works is once you get over $10 of interest, if it's in something like a savings account, if it's in an IRA, you can disregard this part of it. But if it's in some type of savings or liquid savings, once you get over $10 of interest, you're going to get a 1099 tax statement in the mail, and it's viewed as taxed like it's ordinary income. And so that very low rate, where it might be 2% or 3% for the period of time that you have it in or less, then you have to subtract taxes. So then you have to say, okay, what was actually my rate of return on that money? And it wasn't very much. And so the reason you would do a CD is not for tax benefits, not really for growth. It's just to say, hey, it's a place to get some type of growth on my money while I'm in a short-term holding pattern. So not tax efficient, but good for a short-term holding pattern. Now let's compare that with the other side of what we're discussing today, which is an annuity. So CD, you're in business with the bank or financial institution on a short-term basis. An annuity, you're going into business with most likely an insurance carrier or an insurance company. And what they're going to do is they're going to give you benefits three ways depending on your priorities and your goals. So you give them money, and in exchange, they're going to give you benefits that could either be growth. So they're going to give you a set. So like I said, a CD might be 3% for a year. Well, an annuity might guarantee you 5.5%, for example, for 6 years. So a longer period of time, but a much higher interest rate. And so it could be growth. It could be a set interest rate over a period of time, similar to an annuity, but different because it's with the insurance company. 2, it could be guaranteed income. You put a pot of money, you put $100,000 somewhere, you let it grow for a few years, and then they're going to give you a very high income payment. They're going to give you a check every single month for the rest of your life, even if you run out of money, similar to a pension. So they're going to give you income guarantees. Or the third way is they're going to give you protection. So it's a way for you to get better growth on your money than a CD. Maybe your money's correlated with some type of indice like the S&P 500. But they say, hey, if everything goes to hell in a handbasket and the market goes down 20%, you don't lose any money. We're going to protect you, and there's what's called a floor. And so there's really three ways that, okay, you're going to give your money to the insurance company, and they're going to give you one of those three benefits in exchange. Now, you might then say, well, that seems way too good to be true. Why would they do that? Well, it's not too good to be true. Insurance companies and financial institutions get access to things that you and I do not get access to. And so when you give them $1, they have a line out the street of opportunities waiting to give them money that's virtually guaranteed that they will go multiply your money. What would that be? It would be private equity. So opportunities to invest in startups, existing businesses have an ownership percentage. It could be, the big one is corporate bonds. And so large Fortune 500 companies, sports teams, they call these insurance companies because they know the money's safe. And they say, hey, we're building a new stadium or we're building a new corporate office. Can you lend us some money to help us? We'll pay you 7 or 8% interest or a very high interest rate for a period of time, and we'll repay it quickly. Those are very good deals because a lot of times, let's use the example of a sports team, stadiums are typically backed by taxpayer dollars. So then the insurance company gets to go lend money somewhere where they're always going to get paid. There'll be almost zero risk of defaulting and never, the payments falling through. And so they get to put their money and lend to people that will always repay, and there's 2 or 3 levels behind them for them to get paid. So it's very efficient. And then the third way is they go buy real estate. They go buy, skyscrapers and things that are, lacking vacant, they have vacancy. They fill them up, they flip them, or they have lots of cash flow, and now that's money to the insurance company. So they go take your dollar and they go turn it into $10, $20, $30. And out of that spread, they are then able to give you those benefits and guarantees. Now, the difference between a CD and an annuity is where I talked about short-term, yes, CDs go up to 10 years, but typically the benefits are 1 year and less. Annuities, it's really 3 years and beyond. So really 3 to 10 years is the time that you would commit the money. And that's because that's the amount of time that they have to commit that money to see it through to then give you the benefits as an exchange. And so once again, it's not too good to be true, because an annuity is only a fit for you if you're thinking 3+ years, you're thinking mid to long term. If you're thinking in the next 6 months, an annuity will never be a fit for you. But if you're thinking, hey, I want one of those 3 benefits, I want to be ultra protected within those benefits, and I'm willing to say, hey, for the next 3+ years, I don't need this money, an annuity partnering with an insurance company is a phenomenal place to have money, because of all the security that comes with it. And just remember, it's not too good to be true. They are getting access to things that we don't get access to, and that's how they're giving you the benefits. Now, the key too is you want to work with the best insurance companies, because the better their reserves and their financial strength, the better access they get to opportunities. So, imagine XYZ insurance company has $200 billion and another one only has $10 billion. Well, who do you think gets the best opportunities? The one with the most money and the most financial strength, because they're the ones that have the best and the safest capital to lend or give out or invest. They get the best opportunities. So you have to be selective. You can't just go pick any company off the street. You have to do it with reputable companies that have a good business and they've got good cash reserves. Now, we talked about taxes with CDs. Annuities are very tax efficient. So how annuities works is once you put it in, and once again, we're using this, we're not talking about IRA money here. We're talking about money that would have just been sitting in a savings account, or you sold a business and you got some cash now. The money now grows tax deferred. So you get tax deferral. So you get that increased interest rate on your money, or the guarantee. Now you're getting to defer taxes over the period of time. And so let's say you do it for 6 years and you get 5.5% interest on your 100 grand. And you keep deferring, and you say, well, congratulations, genius. Drew, you just got to 6 years and now you have more taxes and I didn't need this money. Well, that's another benefit of annuities. So if you own real estate, or people who own real estate, for investment real estate, there's what's called a 1031 exchange, where you can sell an investment property and roll the gains into another investment property within a certain amount of time and not have any capital gains hit. Well, in the insurance space, it's called a 1035 exchange. And so let's say you get to the end of that duration or surrender period and you don't need the money, you can roll it into another annuity, increase the benefits, whatever it may be, and defer the taxes. If you have a good financial advisor, no bragging here, but somebody like ourselves that focuses on estate planning and knows attorneys, you can actually design trusts and estate plans where you can actually use these annuities to potentially get to the next generation or the generations behind that tax efficiently as well, and keep getting tax deferral. And so not only is it a great vehicle for taxes during your lifetime, but it could be for multi-generations potentially. Now, the key variable is, once again, you got to be thinking long-term. This is the person who is willing to say, hey, 3+ years, I'm willing to set this money aside to get the benefits. And then from a tax standpoint, where it gets very lucrative, is the person that says, hey, this is what I call never money. I'm never touching this money. And I just want it to benefit either my future self when I need care when I'm older, or I want to benefit my children. Or, hey, my children are doing really well financially, that we taught them well. I want my grandkids to be taken care of. Well, it's a place that affords you the options to get good compounded growth, tax deferral, and really control your destiny for your children or your grandchildren from an estate planning perspective. So now let's dive in. Let's finally compare which is best, CDs or annuities. Well, it just depends. It depends on your priority and your financial planning. If you're thinking short term, the CD, 1 year or less, go the CD route. It's a great place, not for emergency funds, but once again, just holding powder money. Hey, I know I got something coming up. I don't need to touch it. Let me just get a guaranteed interest rate before rates drop. The CD is the place to go. Beyond 1 year, you really got to evaluate, do I really need this money? But if it's 3+ years and you're wanting to be tax efficient, the annuity is going to win every single time. Now, the key thing you may be thinking is, well, how can I possibly, I need professional help deciding and deliberating on which is best. And it doesn't have to be or, it could be and. You can do CDs and annuities, and you can do investments and annuities. You can do investments and annuities and CDs. Everything works better when you've got diversified options and you've got different dollars that I have doing what's called a different job description. Everything wealth-wise, it has its different duty and it serves a different purpose. Well, the key is working with a financial advisor or a financial professional that will help you identify and give each dollar a job description. So if you're looking for a financial advisor and professional help identifying and giving you a vision for what your financial planning looks like and giving each dollar that you have its specific job description to meet your goals and objectives, I have a link to my calendar in the description of this video. As always, it's not rocket science, it's just revolutionary.